So the most important thing when it comes to investing is picking the right stocks, right? I don't think so. Let's talk about that. This is probably one of the most important misconceptions that people have about investing when they get into investing, particularly in stocks, but this can also be in mutual funds and ETFs and futures and options and anything else that you find yourself doing. The obvious assumption is that picking the right security is the most important part of the process, and I would disagree. And so would this guy here. One of Warren Buffett's best-known quotes is, rule number 1, never lose money. Rule number 2, never forget rule number 1. Well, what does that get us into? Well, that gets us into what's called risk management. And this is really important. Again, one of the biggest misconceptions is that what many people don't understand about investing in securities is that no one knows where the market's going to go. And I know if you've been on YouTube, you've seen any number of people who say that they're experts on the market, and they're going to tell you where the market's going to go. And they don't know. They really don't know. If we're in the middle of an obvious downturn, if something is broken, they may have a decent idea. But for the most part, they don't know. Well, neither do I, and neither do you. However, you also have to understand that you can be flat wrong on your picking of stocks 60% of the time and still make a fortune. Well, how in the world is that even possible? Well, if you check with the top investors in the world, they have a very simple way of dealing with this. And what's really interesting to me is you'll see a lot of them online saying, oh, this is how I pick stocks, yet they're still wrong. I think that the worst I've ever seen of a millionaire stock investor was he said that he was right only about 35% of the time. Well, how can you possibly be wildly successful as an investor with such a lousy track record? Well, it's easy. Well, kind of. Cut your losers short, let your winners run. That's what that means. In other words, you can't get married. If you're I'm assuming now that you're an active investor. You can't get married emotionally to a stock. So what you might do then is when you enter the trade, you might put in a stop loss. What that means is if the stock price goes down a certain amount that you decide, it'll automatically be sold off. So it might be 1%, 2%, 5, 8, 15, whatever it is that fits your personal strategy. Stop it. Cut your losers short. Then, and letting your winners run can be tough too, because there are days when they're going to go down and you're thinking, I better get out. So discipline is important. We're going to talk about that too. So cut your losers short, let your winners run. I cannot overemphasize that. Risk management can make the difference between a long-term investor and a really short-term investor who just craps out in a few months. So stock picking is important, but risk management is required. Well, what does risk management mean? There are a few things that go into it. We're going to cover 2 or 3 here and then maybe a few more. The first one is position sizing. What that means is you want to be diversified well enough that a bad pick isn't going to kill you. And so what that might mean is someone may not put more than 2% of their entire nest egg at risk through position sizing. So if you do lose 50%, which we don't want to have happen, but it could happen unless you're stopping it. Well, that means you've only lost, if you started with a 2% max and you've lost 50%, that means you've lost 1% of your nest egg. Well, I could live with that. Okay. What I can't live with is one position going south on me and taking out 20% of my net worth, right? Also, it means having an out plan. When I get into a trade, or I'm what's called a swing trader. So I'll be in a trade anywhere from a week to a few months. I don't think about how much money I'm going to make. I think about how much money I could lose. And that's why I use stop losses often. And that might be a percentage, like I said, 2%, 5%. It might be a trailing stop, which means it will trail the stock on its way up. And if you say I want a 5% trailing stop, it'll go up with the stock, but when it then comes down from that higher position, it'll stop at a 5% loss from there. Or you might use technical analysis, say if it drops this far, I'm out. So that's what you have to do if you're trying to exercise proper risk management. Now, this is one simple sentence, and again, I cannot overstate it. There are two parts to this. Creating a plan that fits you and staying disciplined. Well, what in the world do I mean fits you? You just go online, you find a plan, and you run with it, right? Well, you can't, because all of us are built differently. We all have different appetites for risk. We all have different goals and expectations and time frames and everything else. So it takes a while to find a strategy, an overall strategy that fits you. Go ahead and take your time with that, because you want to be able to stay consistent with that over time, and that's where the discipline comes in handy. When you have a plan, you have to stick with it. If the plan is clearly not working over time, then you start tweaking. But you have a plan, you have a solid plan, and then you stay disciplined within the plan. That's another example of risk management. Now, what you don't want to do, and again, in terms of staying disciplined, you don't want to quit after a couple of losses, because you're going to have them. You could have 8, 10, 12 losses in a row. We don't know. Or we do what's called strategy creep. Now, I've done it. You know what? Everything I advise people not to do, I tell them that because I've done it and I've regretted it. Strategy creep is another one. You'll have 2 or 3 trades that don't go your way, so you just change your strategy. It doesn't work that way. It's not going to work that way for the most part. So get a good strategy going. Use a mentor if you have to, or someone that you trust. Get a strategy and keep it going. Don't creep around, because it's not going to work for you. And while you have this strategy, sure, you can tweak it, but then test it. Tweak it and test it. That way you know it's something that you are comfortable with, that you can handle for a long period of time. That is an element of risk management. Now, there are other elements. Diversification. So you want to stay, for example, with one stock from one sector, another stock from another sector, so that when there's a bad day with one stock, there may not be a bad day with another. Now, frankly, there are people who they think diversification is not always such a great idea, and I'll tell you, I'm one of them. I think that, for some people, diversification is a great idea because it stops you from jumping out the window if you have a bad day. On the other hand, if you diversify too much, then you find yourself picking stocks or picking strategies that aren't really the best anyway, so you just want to focus on what you feel are the best ways to do things. Asset allocation, so you have stocks, bonds, or you might have futures, options. You want to have a few different assets in play, so once again, you're cutting down on your risk. If you're a long-term investor and you have mutual funds, for example, or a stock portfolio, you may want to rebalance them every 12 months. And what that means is that the percentage of the portfolio that they are supposed to occupy within your plan goes back to that number. So, for example, if you have Google at 5% of your portfolio and it has a great year and it goes up to 7% of your portfolio, what you may want to do is rebalance it at the end of the year back down to 5% and then rebalance out your portfolio. Hedging is generally for larger investors, or at least mid to larger investors, and that might be where you're heavily involved or invested in one direction. You may find a way to invest in the opposite direction just to kind of give yourself a little bit of a hedge. Exactly. So those are some of the ideas. But the bottom line here is you have to protect yourself first. So yeah, picking stocks is very important, but just as important, and I believe more important, is proper risk management. Protect yourself. That's it for now. Thanks. See you next time.